Phil Plourd, head of market intelligence for Ever.Ag Insights here. Be sure to read the disclaimer at the end of this video. Okay, we're here to talk about Phil Plourd's Monday Morning Demand Notes. That's right, every week we publish notes about the macroeconomic forces and other indicators that we believe matter for demand for the markets we cover: dairy, beef, pork, etc. This week, we inevitably focus on interest rates, but we're not all caught up in the drama of the Fed cutting 50 versus 25, the stock market reaction. While all fascinating, I think the main point is about the change of direction the Fed has made and how long that tends to last. The Fed is typically not one and done. And when they change rates, they don't usually flip-flop 2 or 3 months later. In fact, if you go back to 2001, there's not that many rate change eras, if you will. And when we change, we tend to change for about 36 months. So once the Fed changes direction, we're steady to higher for 36 months, or we're steady to lower for 36 months on average. And so I think we need to be thinking about what that might mean for commodity markets. As we see, there's a lot of money on the sidelines sitting in risk-free assets that were paying pretty good rates under the old interest rate regime. How does that money flow into equities? How does that money flow into commodities in the months ahead as rates presumably are in steady to lower mode? And then the US dollar is also something to keep an eye on. The dollar index is sitting right at 100, major support. For the better part of the past couple of years, I think we've been saying strong dollar equals weak impetus for commodities, but maybe that's going to switch here. If we start seeing the dollar index below 100 for real, maybe we have to start talking about a neutral dollar, or maybe even the dollar being bullish for commodities. That's it for now. If you're interested in getting Monday Morning Demand Notes, click the link in the bio.